Hello, everyone, and welcome to Currency Exchange, a NatWest podcast series all about foreign exchange markets. I'm Brian Daingerfield. I co-head G10 FX strategy here at NatWest, and I'll be your host today. And I'm happy to be joined by Paul Robson, who co-heads G10 FX strategy with me, sitting in London to talk all things currencies. You know, we've had a few weeks here where we've done combination episodes with our sister podcast Bondcast, but today we're back on the Currency Exchange channel talking all about currency and foreign exchange market focus. So, Paul, thanks very much for joining.
Well, as always, Brian, thanks very much for the invitation. Very much looking forward to digesting recent moves in FX and thinking about where we think that currencies might go over the coming weeks and months.
Yeah, absolutely. And Paul, I do want to ask you a lot about European currencies as we head through, but maybe before that, we should just start talking about the big dollar because, of course, we have seen a lot of moves and it's been a very volatile period. And just try and take stock of where we think we are in terms of trade policy, shifts in dollar exceptionalism, and maybe some of the upcoming data as well. So we've been leaning negative on the dollar here, particularly versus alternative safe havens. If you've been listening to our previous currency exchanges and also to the combo episodes with Bondcast, we've been talking a lot about how trade policy uncertainty and shifts in expectations around U.S. growth we think are really sapping dollar exceptionalism here. And I think there's a cyclical component to this and there's a structural component to this. From the cyclical side, I think it's pretty clear that risks to the outlook for U.S. growth have clearly moved more to the downside. Just to put some numbers on this, relative to GDP growth, fourth quarter for 2024, in the high twos here in the U.S., NatWest economists are actually now thinking that the U.S. economy grows just over 1%, 1.2% year over year for 2025. So that's a pretty meaningful down step in terms of delivered growth here in the U.S. And a good portion of that reduction in growth expectations does relate to these rapid changes in policy, whether it be because of tariff policy uncertainty or because of how tariff policy has influenced consumer confidence, business confidence, CEO confidence. We do see some evidence about rising uncertainty among businesses in the U.S., maybe leading to hiring plans, slower plans for capital expansion. We've seen some businesses talking about concern and uncertainty about the path forward for demand in the U.S. And so we think the U.S., which previously enjoyed a period of economic exceptionalism, where the markets see the U.S. and the U.S. dollar and the U.S. equity markets as really the only source of growth in the global economy, we just think the U.S. economy has now seen a downshift in terms of expectations. And we've also seen equity markets underperforming here relative to some of their international peers. And that's particularly important because one of the sources of dollar strength we think, over the sort of longer term trajectory, we think has been these flows of offshore money into U.S. markets, particularly U.S. equities. A lot of that money has probably been unhedged simply because the dollar has been strengthening as well throughout this move. Higher in equities is relative outperformance in U.S. equities. And so as those correlations shift, as we've seen equity market weakness along with a weaker dollar, we think that has led to some changes in the way that international investors are thinking about their dollar holdings and how they approach not just their equity holdings, but how they hedge those equity holdings. So we think there's a cyclical component here, which is that U.S. growth is likely slowing. We're a little bit less sure that comes as quickly as the markets are currently pricing, but we do think that there's a relative growth story here. There's also a structural story to consider, which is whether these rapid changes in policies are leading to a pickup in speed of de-dollarization. Now, I continue to think personally this is a slower burn story, that the U.S. is still the largest global economy, largest, most liquid debt market, still a current account deficit country, tends to be in a pretty decent position in terms of global reserve currency. And no currency really, I think, claims the mantle of an alternate that really matches the dollar in some of these important metrics. But, and we'll talk about this in a second, Paul, maybe only a small shift in approach to the dollar could have very meaningful implications. So as we look ahead to the data here in the U.S., and I think that still should be the big market focus, is we've seen a lot of the data on the hard data side in the U.S. have actually still remained pretty strong. You think the U.S. employment numbers have held in, retail sales have been very strong. What I worry about is that some of this demand may be preloading of demand because of concerns about tariffs. We see this in the import numbers where imports surged in the first quarter as businesses look to try and get ahead of tariff implementation. Retail sales, and particularly auto sales. And so what we'll be watching very closely, I think we should, in the coming weeks is whether or not there's some natural give back in some of these hard data simply because some of that demand was preloaded. So, as we look ahead to the data, I think it's important to watch the hard data for signs of, is hiring intention starting to slow? Is that starting to feed into employment data? And just as critically, are we already lining up for some slowdown in some of these demand data simply because, if for no other reason, some of that demand was already preloaded and there's already a natural move towards some relaxation? So continue to see downside risks here for the dollar broadly. And Paul, I want to bring you in now to talk specifically about euro dollar. This week has been relatively quiet compared to where we have been in terms of directional market moves. I mean, looking at euro dollar as we record here on Thursday, it's effectively unchanged on this week, but certainly at levels that are much higher than prevailed at the beginning of the year. On Monday, I believe we breached 115 for the first time in several years. So where are you thinking about euro dollar from here, and what are some of the risks that you're watching?
Yeah, as you say, Brian, thankfully a quieter week for FX markets as I think currency markets just settled down a little bit after what have been quite significant moves, and as you've just pointed out, really focused front and center on the dollar, and that I think the outlook for both euro dollar and sterling dollar is going to continue to be a focus. Focus around what happens to the dollar. So as always, Brian, I'll be listening very carefully to what you think in terms of US policy and where the dollar is going. Just in terms of global currency markets, I think very beholden to the shifting sand of US policy, whether it's trade policy, domestic policy, international trade policy. That certainly will be the current driver. Everything you said about the dollar, the European currencies are just the other side of that. Obviously, money, if it does in fact leave the US, it can go to lots of destinations, but one of the destinations appears to be Europe, and that's why you've seen, for example, the euro outperform, and I think there's reasons to think that continues. As you quite rightly pointed out, I mean, we have looked for both sterling dollar and euro dollar to rise through 2025 when we published our year ahead all the way back in November. It seems an awfully long time now. That said, and let's be honest about it, the moves have come a little bit more quickly and maybe to higher levels than we expected, but we don't think the direction of travel was necessarily a surprise, but maybe like I say, the pace and the levels to which we get to, and also Donald Trump's policies may have been a little bit more aggressive than we had expected, but nevertheless, we thought that the dollar was expensive, and also within this view that markets had got to a point of peak optimism maybe around the US. You talked about US exceptionalism. We seem to have been talking about that for the last seems like ever at the moment, and peak pessimism around the euro area, and the policy changes in the US echo into Europe, and we've had quite a significant change in reform, defence spending, infrastructure spending, and that's new and important information. When I look to the outlook, I think the drivers are going to be very similar. And for me, there's three areas, and in fact, you covered them in a very good way and detailed way. But the diversification away from dollar assets at a sort of an official level. That will be interesting to see whether that continues, to what extent. You said you were relatively cautious on that, and the thing about reserves, they do tend to move very, very slowly, so that seems a perfectly sensible position to have. Asset allocation, regionally, do you get a shift of investor appetite away from the US, and crucially, what assets and which destinations? And again, that would be fundamentally, that's very at the heart of FX markets, about equity flows being unhedged potentially, bond flows being hedged. That's important. And one of the areas that I think remains important, and this is obvious in the balance of payments data from the US, and that's the stock of retained foreign earnings in the US. I think corporates have, it seems quite sensible to have kept their earnings in the US when the dollar was strong, the US economy was strong, and interest rates were high. Why would you move it around if you don't see investment opportunities elsewhere? And if that starts to shift, that's a potentially very large amount of money. So very much watching the money, watching the cash, and see where it goes. And currencies will undoubtedly follow, I think.
Yeah, I think we spend a lot of time thinking about central banks, thinking about relative carry, and rightly so. But there are, at the end of the day, this is a flow product, right? And these capital account, current account balances really do matter. I mean, spend a lot of time thinking about the dollar's privilege of, not necessarily being as susceptible to, weakness as a result of persistent deficits, and some questions around whether that might be changing. So I think it's right to be thinking about some of these bigger issues around. Current and capital account rather than necessarily just around the very specific minutia of Fed policy versus ECB or Bank of England policy. You also mentioned about FX diversification. What are you thinking about reserve diversification, and how is that impacting how you're thinking about global currencies? Eurodollar, I think the most important in that discussion, but global currencies.
Yeah, I'm just very much on the same page as you, Brian, as always, about foreign exchange reserves. So I actually reminded myself of just how large foreign FX reserves are globally. 12 trillion dollars. And as you quite rightly say, small changes in the percentage of holdings, 0.1, 0.5% of a very large number can have potentially quite big impacts. And when we think back to the last sort of 20 years, the last time the dollar was very weak, or let's keep it sort of European, the last time that sterling dollar and euro dollar were very strong is when we were having a rotation out of the dollar, both in terms of the stock and new flow as central banks were intervening to keep currency strong at the beginning of the noughties. And that ran into the global financial crisis, and eurodollar was at above 150. I think it might seem a long time ago, but when FX reserves move and reallocation, that can potentially be important. And it's just useful to remind ourselves about the share that the dollar has in that 12 trillion amount of dollars. And it used to be about 70% way back in the sort of late 90s, and now it's just over 50%. It's been drifting a little bit lower over time, but nothing too dramatic. And again, very similar to your view, I don't think we suddenly wake up on one Monday morning and the dollar's lost its reserve currency status and there's been wide selling of dollars. But maybe what we've seen over coming weeks might just echo into the future and see that share just drift a little bit lower. The yen's a really interesting one. I know we've got the Bank of Japan, we've got inflation numbers. I'm very keen to hear what you think about that in terms of how the yen reacts. But that's been drifting higher as a share. Remember, interest rates in Japan are no longer zero. It's a big economy. It's an important currency. So it'll be interesting to see how dollar yen might react to that. In terms of the euro, it stands around 18%, so less than half of reserves of the dollar, even though it's an economy of 540 million consumers and a big economy. It just shows you how important the dollar is in terms of global FX reserves. It got hit a little bit, that ratio, in the euro area sovereign crisis in the sort of around 2012 and never really recovered. It'll be interesting to see whether we could take back some of that. And if it's 2% or 3% of global reserves, that's a lot of money potentially going into European assets. And what's interesting here is maybe Europe finally is providing the liquidity that people have always said that the euro doesn't provide because of constrained budget positions. But obviously, one of the implications is looser fiscal policy in Europe and the carve out of defence spending. That potentially matters as well. And keeping it quite close to home, finishing off sterling, much smaller, 4% of global reserves. This isn't sort of 1910, where I think the reserves were significantly higher. It's been drifting a little bit higher over time. It didn't really get impacted by some of the international policy decisions of the UK. And isn't it interesting? The UK's got quite high yields, and this is a very fine balance here. In previous episodes, I've talked about the risks of fiscal policy, obviously via gilts into the currency. But for some asset managers, a yield of 4.5% might seem it's a nice alternative to the dollar. And if you want exposure to the euro and the euro area, there's plenty of liquidity in gilts, sometimes potentially too much. And so it'd be interesting to see whether sterling gets that. And sterling is a slightly smaller currency. Maybe it's influenced a little bit more by flow. And again, it's a small percentage of a very large number. It just makes me just wanting to watch that very carefully over the next quarter, especially.
Yeah, really interesting discussion as well. Thinking about things like what are the risk premium in these economies? Is there a differentiation there? What about volatility? And also market size and depth, which I think is very important in that liquidity, which you rightly mentioned. Now, you mentioned sterling in your discussion at the end there, so I don't want to let you get off the hook without talking a little bit about some of the more short-term drivers driving sterling. So, what are your latest thoughts here? I mean, sterling has outperformed, alongside dollar weakness. Recently it's pulled back a little bit of its losses against the euro. How are you thinking about sterling here?
Yeah, I think the weakness against the euro we had a couple of weeks ago. I think that might have been evidence of a little bit of market dislocation, thin liquidity, had the school holidays. I think the moves weren't totally justified, even though we thought that sterling would underperform. It just underperformed significantly more than we expected. I think that sort of corrects a little bit, and so maybe turning a little bit more neutral on sterling just because of where valuations are. And the point I make about FX reserves and a home for money that potentially leaves the US in terms of UK property law, UK law just generally. I might just see the UK benefit in terms of that. The ratio in FX reserves global FX reserves pretty low. But this week, we just had another warning about sterling's potential risk premium in terms of fiscal policy again. So another set of borrowing numbers from the government, showing an overshoot relative to recent projections, and with a high stock of debt, high funding costs, debt servicing costs, and weak growth. Fiscal policy is something I'll be watching very, very carefully, and it keeps me cautious on the currency, but short term a little bit better. In terms of the Bank of England, nothing really shifted. The Bank of England speakers this week playing, as I would say, as an Englishman, a straight bat in terms, but they were a little bit more worried, I think, at the margin about growth to the downside. Markets look fairly well priced, I think. Our economics team think we get 3 quarter point cuts by the end of the year. The market's a little bit more than that. But given all the uncertainty around on both sides of the Atlantic, I don't think you can have a strong view on that. So at some point, you might get a reconnection with yields, but as I say, maybe turning a little bit more neutral. That's the European currencies, Brian. I said I was keen to get your thoughts on Japanese CPI and the Bank of Japan meeting. I'm just wondering how you think that all plays out for the yen.
Sure, yeah. So the Bank of Japan has their May 1st meeting coming up shortly here. And given tariff uncertainty and the potential downside risk to growth from the lack of resolution of that tariff uncertainty with the US, it seems very unlikely that the Bank of Japan is going to raise interest rates to continue its normalization at that meeting. There have been some speculation, myself included, wondering that, if you were to get let's say Japan were to completely avoid tariff escalation, or the April 2nd announcements were going to be a lot less dramatic, a lot less aggressive than they were, whether or not there was an opportunity for the Bank of Japan to resume normalization in May because of some of the internal concerns around labor shortages and persistent wage inflation. But that feels like it's been pushed to the back burner a little bit, given the immediate term risks around tariffs to the outlook. So I think that is widely consensus, if not unanimous consensus in the market, that the Bank of Japan does not hike the policy rate in May. But I think the focus will be on what comes out in the outlook report. So the Bank of Japan will also be announcing new forecasts. And in particular, I think the market focus should be on these inflation forecasts because, since the Bank of Japan last did their forecast update, a couple of important things have happened. Downside risks to growth, have picked up because of tariff-related risks. At the same time, you've seen a much stronger currency and lower dollar-denominated energy prices. So when you take this together, we think there's a pretty good case for the BOJ to revise down some of their inflation projections. This is especially the case in the headline CPI, which is core CPI, which tends to be a more important driving factor for central bank policy. That doesn't take into account oil prices, necessary energy prices, maybe a bit less sensitive to currency strength. But we think it's likely that the BOJ is going to revise down some of its forecasts. And now the Bank of Japan has been telling the markets for a long time that normalization of policy, further interest rate hikes, is going to be dependent on them being able to meet their central inflation scenario, which is getting inflation, core inflation, back to target in a sustainable way. What we worry about here is how will the markets respond if the inflation forecasts are revised down from where they were early this year. And I think the Bank of Japan is going to have a difficult time ensuring that their guidance matches up with this, because when the Bank of Japan, at its meeting, at its last outlook report meeting, they revised up those inflation forecasts significantly with a big focus on internal factors and labor market shortages. If anything, those concerns have intensified. Junta wage rounds have pretty clearly shown continued upside pressure on wages. That's the good news for the Bank of Japan. The more challenging picture is what happens if the market sees the Bank of Japan having revised down their inflation forecasts, which is effectively a reflection of the Bank of Japan in its projections being maybe less confident about reaching its inflation scenario. And so when I think about yen here, which, as recently as a couple of days ago, testing 140 on the downside, and the yen having had a pretty nice run here, with all the focus being on relative growth, relative shifts in dollar exceptionalism, and the yen trying to claw back some of its status as a safe haven currency. All of that, I think, still remains as the main driving force for yen here. But we do have this Bank of Japan meeting coming up where I feel like there's a clear risk that the BOJ revises down some of their inflation forecasts, and the market sees that as maybe a signal that they don't have to move as quickly on policy. And so I do worry that the Bank of Japan meeting, the market might take that as a little bit dovish when you consider the big rally that we've had in yen. Maybe you see some room for some tactical retreat of that move if we do have the Bank of Japan moving down those forecasts. But what I'll be listening very closely for is whether the message stays the same, as in they try and come out and signal, yes, the inflation forecasts are lower because of these external factors, but we still think the normalization process is on pace because we have these internal inflation drivers. So I think there's a risk here that the yen, the rally we've seen in the yen maybe pulls back a bit here if the market sees something a little bit more dovish from the Bank of Japan. But I think the driving force for yen is going to be those global factors. And if the dollar continues to weaken here as these dollar exceptionalism questions continue, that's probably a more pressing and important driver, and one that could be seen as a more medium-term positive for the yen. So on that note, Paul, thank you very much for joining. This has been a really great conversation. And thank you to our listeners for listening as well. If you enjoyed today's podcast, please consider giving it a like and also subscribing to our channel so that you can get our latest podcasts when they're released. Thank you very much.